All right. So, trading plan and funded guide part 3. So, what I wanted to touch on today, because yesterday we touched on the homework as well, and we had a brief overview of all the steps in the funded guide and what is needed to get funded, etc. Now I want to zoom in on the specific topics that we talked about. So first we talked about concepts, then we talked about trading plan. Of course, the concepts have already been taught in the enrollment. If you haven't watched those, then it's futile to watch the funded guide. So please watch those first. So in your trading plan, you will have a few phases, and the phases are: you will first have an analyst phase. So that is exactly the first week we go over in an enrollment month. That is the higher time frame analyst phase. Then you have an execution phase, and inside that execution phase, you have your risk management, etc. Then psychology is also something we will get into as well. Now, to form a trading plan, what do you actually need? If you're using the filtering process, you have an analyst phase, right? The first phase. For a flow trading plan, you also have an analyst phase. Only thing that differs or that's different is the time frame. So for a flow trading plan, you would use a 1 hour minimum time frame to get to a bias, to get to a drawn liquidity. For a filtering process trading plan, I would always advise use a 4 hour minimum to get to a drawn liquidity, to get to a bias. So inside that analyst phase, you would want to see something. You would likely want to see an order flow lag, trade back into a fair value gap, overlapping with an order block, breaker, whatever is currently right there. That is what you would want to see. That can be a higher time frame ST, can be a higher time frame RE, for example. That is all perfect, right? That is where the intuition comes in, and that is where I think you don't need to be fully mechanical. And the reason why you don't need to be fully mechanical is because there's not a lot of emotions involved when you are trying to analyze. It's very easy, and that's I don't mean to say it's easy to know where price is going, but it's easier than to actually execute. Analyzing is always easier to actually be a trader than to actually be a trader. And what you'll usually hear, and that's a phase I believe all traders go through, is at the beginning you're a great analyst, and then afterwards you become a great trader when you actually start executing. And the reason why a lot of people aren't great traders and why they can't execute is because that's where the emotions are getting involved, right? So that is where you need to have guidelines. You can't discuss it anymore. You need to have guidelines because those emotions are involved when you dive into the lower time frame and it's ready to click the button to actually open a position, because that's the scary part. The analyzing phase is not that scary. So when you have your analyst phase checked off, so you know on the higher time frame you would want to see something, you would want to come into an order flow lag, you would want to have 100% bias. So what I mean with 100% bias, you would want to have a one-sided market where you can only make bullish or bearish arguments, nothing else, nothing in between, not 80% bullish, 20% bearish, no, 100% bullish and 0% bearish if you want to look for longs, of course. So that is what you would want to have. Then when you have that and you trade into a higher time frame PD array, or of course a 1 hour PD array, and you trade into that, that is when you want to have determined, you know, exactly what you are going to do in the lower time frame. So you already know which time frame you are going to go into. I know for my normal trading plan, if there's a 4 hour higher time frame PD array, then I go into the 5 minute. I go into the 5 minute, I want to see an ST, I want to have a RE. I know exactly how an ST is defined, and I know exactly what defines an re-entry. So there is no question about it. I know exactly what that is. So of course, an ST, displacement in, displacement out. That is my ST. Perfect. Then I want to have a re. What is a re again? A re is when we trade back into the ST, or not necessarily back into the ST, but any discount that is in close, discount rate that is in close proximity to the ST, can be a fair value gap, can be a breaker, and then we have a new fair value gap higher, a new displacement higher. That is your re. So that is where I want to get involved. Any discount array that's there. Preferably the first discount array that's there. So that can be a fair value gap, whatever. So that is my entry pattern. I know where I want to get involved exactly ahead of time. I know if this happens on the higher time frame, if my analyst phase plays out, then I want to get involved with a 5 minute ST and then a 5 minute re. And then I want to get involved. So that is exactly, I have already set out the guidelines on how I want to get involved. And the reason, again, why this is important is because when you are going into that lower time frame, then the emotions will start to rise, and then you need to have guidelines to your trading plan at that point and that moment in time needs to tell you exactly what you need to do at that moment in time. So when you dive into the lower time frame, your trading plan will tell you, all right, I need to wait for an ST and I need to wait for a re. Once we have the re, I can get involved. That is exactly what you need at that time. Then, of course, the next part is risk management. So risk management is when you are in the trade. That is what I would determine risk management. So I'm not going to touch on the risk percentages here. But what you would do is you would have your stop loss. You would need a break-even level. If you go break-even, if you even have a break-even rule involved in your trading plan at all, and then you need a take profit level. So the take profit level, that can be that opposing higher time frame PD rate, right? That can be a take profit level. Now, if it's too far or if it's too close, then I would adjust it to a 1 to 2. What is too far? Define too far. I think everything above a 1 to 3 when you're just starting out is too far. I would just go for in between 1 to 2 and 1 to 3. That's perfectly fine. If it's less than a 1 to 2, I would just aim for a 1 to 2. So everything in between a 1 to 2 and a 1 to 3, let me write it down as well. That is perfectly fine. That is exactly how I would do it when just starting out. That is perfectly fine. Then that is your take profit. All right, perfect. So your take profit is set. You know what you want to target. Then the next thing you need to have is, of course, your stop loss. Where is your stop loss going? Is it going, and this is where a little bit of a, it's not fully objective, but if you can cover an intermediate term low or an intermediate term high, I would always advise to cover an intermediate term high or intermediate term low if it isn't at the expense of your RR. So if you're now, your initial target was a 1 to 2, 1 to 3, perfectly fine, and then you covered intermediate term low and intermediate term high, and it's all the way up there or all the way lower, your intermediate term low, then, and you're only aiming for a 1 to 1 now, that's not nice. That's not what I would want to do. So cover a logical place where price doesn't have to retrace back towards. How can you determine this? This is determined by, first off, having every time frame in context of the time frame above it. So if you're entering on a 5-minute time frame and you have a 5-minute fair value gap sitting below an order flow leg, that's not a big deal. Unless if you now zoom out, and with zooming out, I mean you go up in time frames. So you go up to the 15-minute time frame, and there's a 15-minute fair value gap sitting below a 5-minute order flow leg. Then you need to be careful that you also cover the 15-minute fair value gap, because it can very well sting into that. So that is exactly how I would go about that. Then the next thing is going break even. You can also have, some people don't have a break even rule at all. So that is also fine if it's backed by data. But if you're just starting out with a funded account, I would always advise to just use a break even rule, whether it's detrimental to your equity curve, to your profits, etc. at the beginning. Doesn't matter. I would always advise to go break even first. So reason being for that is because at the beginning, when you're just starting out, you are likely more susceptible to mental hits. So when your stop loss gets hit and you could have gone break even very easily, then you might get a huge hit on your psychology at the beginning. So when you get some skin in the game and you have a thick skin, when you have more experience as well, then it is okay if based on data, very important, that you remove the break even rule so you don't go break even anymore. Now, how would we go break even? Again, it is the same premise that I would use on placing your stop loss. Now we only move the stop loss a little bit higher. Again, where does price have no reason to come back? Again, this is all taught in the enrollments as well. Where does price have no reason to come back? Based on order flow, based on the time frame above it. So every time frame needs to be in context of the one above it. So again, if we have a perfect move away from a 5-minute fair value gap where we entered, and we now have a new displacement higher, again, then the thing you would want to see is, let me draw it actually. Let's say we have this ST and we want to enter on this fair value gap right there. That is our entry. And this is our stop loss right there. Then right there we enter. And let's say that we have a perfect move away right there. Would we go break even if this right there was our entry? Based on a 5-minute basis, yes, you would likely go break even, especially because you're close to the low, etc. You would go break even. But again, it's the same story on using the stop loss technique. If there was no 15-minute fair value gap here, then you would place your stop loss right here, right? Based on that 5-minute order flow lag. But if there is a 15-minute fair value gap right there, you would likely place your stop loss below that low. If that isn't there, so if there's no 15-minute fair value gap right here, then you would place your stop loss right there. Same premise here. If you now have a new 5-minute order flow lag, you would again go up a time frame and see what is happening on the 15-minute. Is the 15-minute also having a new 15-minute fair value gap right here just below that order flow lag? Then I wouldn't go break even just yet, and I would just keep my stop loss right there. But if there's no 15-minute fair value gap or no 1-hour fair value gap, etc., then I would go break even and would place my stop loss just below that low or right at break even right there. That is exactly how I would do it. Again, you cannot expect, or it's illogical to expect price to come back all the way down towards that low exactly to the pip and then continue higher. So I would just, even if the entry was here, I would just go break even right there, especially if your take profit is pretty close as well and you've already reached a 1-to-1 RR. This is exactly how I would do it. So I hope it makes sense, and that is essentially the things you need. So you need to have a plan from the higher time frame down to the lower time frame. Every single thing needs to be measured right there. So the analyst, all right, can be somewhat subjective, but you know you have a great idea based on the enrollments, where you want to get involved, where price is likely going, also based on structure, order flow. It's basically what you're doing on the higher time frame is you are looking for a higher time frame entry pattern. You're doing the exact same on the lower time frame, only you're now doing it on the higher time frame, right? So you're inside that higher time frame entry pattern, you are going down into the execution phase where you now look for a lower time frame entry pattern. And the lower time frame entry pattern, that is again established through an ST, a RE, everything that is being taught in the enrollments. Then once you enter and you know where you want to enter, then you use the risk management. So your break even, your take profit, your stop loss. Of course, first your stop loss, first your take profit, and then you can go break even. That is very important. All right, perfect. And then once you have this, you already have a great trading plan. And I think you are ready for the next step, which is applying risk management and certain risk management that we can use. So that is the next video. All right, perfect. Thank you.